The story of money, one of the greatest inventions in human history, is in fact the story of civilization and social trust itself. This story begins in the era when hunter-gatherer communities lived in small groups and the concept of property had not yet taken shape in its modern sense. Life at that time was built upon a simple equation of needs and supply. However, as communities grew and people began to specialize, the exchange of surplus production became a necessity. At first, the method used was barter, that is, the direct exchange of one good for another. Yet the barter system inherently contained major inefficiencies. For a fisherman to obtain an axe, it was not enough to simply find an axe maker. At the same time, the axe maker also had to need fresh fish at that exact moment. This requirement of a coincidental coincidence of wants was the greatest obstacle to trade. To overcome this barrier, humanity began to use objects that everyone attributed a common value to durable and easily portable items as commodity money. In Mesopotamia, barley. In different parts of the world, seashells. Among the Aztecs, cocoa beans, and even salt in the Roman army became mediums of exchange. However, these natural objects lacked standardized weight or quality, which still made trade somewhat insecure. The true evolution of money took a revolutionary step in the 7th century BCE on Anatolian lands, during the era of the Lydians. When King Alyattes of Lydia produced the first known minted coin in history, he created not only a medium of exchange, but also a symbol of state authority and guarantee. These coins, made of electrum, a natural alloy of gold and silver, carried a seal that guaranteed their purity and weight. This seal represented a state commitment declaring, in effect, this piece of metal is under my protection, and its value is fixed. The invention of coinage increased the speed and volume of trade to levels never seen before. There was no longer a need to weigh metals or test their purity in every transaction. From the Greek city-states of the Mediterranean basin to the Roman Empire, this system spread rapidly. Rome used money not only as a commercial instrument but also as a tool of propaganda and political power, sending the emperor's portrait to even the most distant provinces. By the Middle Ages, coins were still in use. However, transporting large quantities of gold and silver posed both a heavy physical burden and a significant security risk. It was precisely at this point that the process of money's abstraction began. During the Tang and Song dynasties in China, merchants started leaving their heavy metal coins with trusted custodians and receiving promissory notes or receipts in return. Because these pieces of paper could be converted back into coins on demand, they began to circulate confidently among people. Thus, the world's first paper money, known as jiaozi, entered the stage of history not as a physical store of value, but as a representation of value. In the Western world, this transformation progressed largely in parallel with the development of the banking system. In the Italian city-states, and later in the Netherlands and England, deposit receipts issued by goldsmiths evolved into banknotes. When the Swedish bank printed the first official banknotes in the 17th century, humanity had begun to trust not the intrinsic value of the object it touched, but the promise that object represented. This marked a massive psychological threshold in economic history. While paper money enabled central authorities to control the economy more easily, it also introduced new risks, such as inflation, resulting from excessive issuance, into the system. With the establishment of the gold standard system in the 19th century, the abstract nature of money was stabilized to some extent. Under this system, every paper banknote was backed by a physical amount of gold held in the vaults of central banks. People knew that when they took their paper money to a bank, they could exchange it for a fixed quantity of gold. However, world wars and economic crises severely challenged the sustainability of this system. With the signing of the Bretton Woods Agreement in 1944, global currencies were pegged to the US dollar, and the dollar itself was pegged to gold. Yet this arrangement did not last long. In 1971, when U.S. President Richard Nixon announced the complete removal of the dollars linked to gold, the era of fiat money truly began. From that point on, money was no longer backed by any physical gold reserves. The only power behind money became the economic and political credibility of the state that issues it. The Turkish lira, the dollar, or the euro we use today are, in essence, nothing more than agreements of trust. By the 21st century, money had almost completely detached from its physical form and become digitalized. Today, Only a very small fraction of the world's money exists as physical cash or coins. The rest consists merely of ones and zeros stored on bank servers. Credit cards, contactless payments, and digital banking have transformed money into nothing more than numerical data. The blockchain revolution, which began with the emergence of Bitcoin in 2009, pushed this process even further. It is now being debated whether money even needs a state or a central authority at all. Cryptocurrencies represent the most radical transformation in the history of money, a decentralized, borderless system based on mathematical algorithms. This 5,000-year journey of money, from seashells to blockchains, reveals how the human mind has continuously redefined the concept of value. Money began as a tangible commodity, evolved into a promise backed by the state, and ultimately turned into pure mathematical code. Yet throughout this long journey, one thing has remained unchanged. The power of money does not depend on what it is made of, but on the shared belief that it carries value. Whatever form money takes in the future, this collective sense of trust will continue to be the fundamental building block of the economy.